Welcome to StokTok's deep dive into ConocoPhillips. ConocoPhillips is one of the world's largest independent oil and gas exploration and production companies, with operations spanning multiple continents and a diversified portfolio of conventional and unconventional assets. At the time of recording, ConocoPhillips was trading at 1,221.2, having moved up 3.59% recently. The stock is positioned between its 52-week low of 842.8 and its 52-week high of 1,358.7. The Relative Strength Index, or RSI, stands at 48, indicating neutral momentum. The 50-day moving average sits at 1,208, while the 200-day moving average is at 999.74, suggesting the stock remains above its longer-term trend support. Let's work through the fundamentals, scene by scene, starting with a quick business overview. ConocoPhillips generates revenue through the exploration, development, and production of crude oil, natural gas, and natural gas liquids from onshore and offshore reserves. The company's competitive advantage rests on its massive reserves base, established operational footprint in stable jurisdictions, and ability to execute large capital projects efficiently. The firm benefits from commodity pricing exposure, which creates both upside and downside volatility depending on the macro energy environment. On the StokTok score, ConocoPhillips registers at 56 out of 100, signaling a hold rating. Breaking that down, Valuation scores 17 out of 20, suggesting the stock is reasonably priced relative to fundamentals. Financial health scores 13 out of 20, indicating a solid but not fortress balance sheet. Profitability scores 10 out of 20, reflecting the cyclical nature of energy businesses. Growth scores 8 out of 20, a key constraint. And smart money activity scores 8 out of 20, suggesting tepid institutional conviction. Now, valuation. The question every investor has to answer: are you paying the right price? ConocoPhillips trades at an 18.3 times trailing 12-month price to earnings multiple, or PE ratio. Looking forward, the consensus forward PE is 14.5 times, a meaningful discount to the trailing multiple, suggesting the market expects near-term earnings growth. The price-to-earnings-to-growth ratio, or PEG, comes in at 0.59, which is attractive. A PEG below 1 typically indicates the stock is trading at a discount relative to its growth rate. However, growth is the constraint we'll examine more closely in Scene 6. The enterprise value to earnings before interest, taxes, depreciation, and amortization ratio, or EV to EBITDA, sits at 6.18 times. This is a reasonable multiple for a stable, cash-generative energy producer. The price-to-sales ratio is 2.47 times. In our view, these multiples suggest ConocoPhillips is not egregiously overvalued. The GuruFocus Value, a blended intrinsic value estimate, stands at 1,040.9 at the time of recording, compared to the current stock price of 1,160.4, implying the stock trades at an 11.44% premium to estimated fair value. That margin of safety is negative. The stock is not trading at a deep discount to intrinsic value estimates. Wall Street analysts, at the time of recording, have a consensus mean price target of 1,338, with targets ranging from 1,000 to 1,833. This suggests the street sees meaningful upside from current levels, though that view assumes energy fundamentals and commodity prices remain supportive. The next earnings report is due April 30th, 2026, with the street expecting earnings per share of approximately 1.67, with estimates ranging from 1.33 to 1.75. That is a near-term catalyst to watch. From a peer comparison perspective, independent oil and gas producers historically have traded in the range of 12 to 18 times forward earnings, so ConocoPhillips' forward PE of 14.5 falls within that historical band. Market sentiment around ConocoPhillips, as of the creation of this video, leans neutral. There is no concentrated bullish or bearish narrative driving the stock. In our view, the valuation looks fair, neither compelling nor unattractive on a stand-alone basis. Moving to financial strength, how solid is the foundation? The Piotroski F-score, which evaluates 9 financial health metrics ranging from profitability to leverage to operational efficiency, registers at 5 out of 9. This is a below-average score, indicating some financial stress signals. Specifically, this suggests caution regarding the quality of earnings or the trend in financial position. The Altman Z score, a bankruptcy risk model that combines profitability, leverage, liquidity, and solvency metrics, comes in at 3.16. A Z-score above 2.99 falls into the safe zone, so ConocoPhillips clears that threshold. But only narrowly. Management is operating in the gray area rather than with fortress balance sheet metrics. On the leverage side, the cash-to-debt ratio is 0.30, meaning the company holds 30 cents of cash for every dollar of debt. This is a tight ratio, leaving limited liquidity cushion if commodity prices or capital access deteriorate sharply. Interest coverage, which measures how many times operating earnings cover interest expenses, stands at 9.2 times. That is solid. The company is generating sufficient operating cash flow to service debt comfortably at current production and pricing levels. The current ratio, a measure of short-term liquidity, is 1.30, meaning current assets cover current liabilities 1.3 times. This is adequate but not conservative. The debt-to-equity ratio is 0.36, which is moderate. In summary, the balance sheet is functional and generates sufficient cash to service debt, but it lacks substantial cushion. If we see extended weakness in commodity prices or a capital spending squeeze, this financial position could come under pressure. The verdict here is cautious. Financial strength is adequate but not a fortress. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, stands at 6.57%. Return on invested capital measures how much profit the company generates for every dollar of shareholder and creditor capital deployed in the business. For an integrated energy company, 6.57% is respectable but not exceptional. Many industrial and manufacturing businesses target double-digit return on invested capital. This reflects the capital intensity of oil and gas production and the competitive nature of the sector. Moving through the profitability stack, gross margin, which measures revenue minus cost of goods sold as a percent of revenue, is 25.09%. Operating margin, the percentage of revenue remaining after all operating expenses, stands at 19.24%. That is strong, indicating management is extracting operating leverage from the business. Net profit margin, the bottom line, is 13.55%. This means that out of every dollar of revenue, the company keeps 13.55 cents as profit after all expenses and taxes. Free cash flow margin, which measures the percentage of revenue converted to actual cash available to shareholders and debt holders, is 12.29%. This is meaningful and suggests the company is not just reporting profits on an accrual basis, but actually converting those profits into cash. The sequence from operating margin down through net margin to free cash flow margin tells us the business is reasonably efficient, though some margin is lost to interest, taxes, and maintenance capital spending. In our view, profitability is solid and generates genuine cash, though it is leveraged to commodity prices and capital discipline. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years comes in at negative 9.10%. This is a significant headwind. The company has shrunk revenues in aggregate over that recent period, likely reflecting a combination of commodity price weakness, asset sales, or production declines. However, expanding the time horizon to 5 years reveals a different picture. Revenue growth over the past 5 years is 17.30%. This bifurcated view suggests that ConocoPhillips faced a down cycle 3 to 5 years ago, but has since recovered. The near-term 3-year number is the more relevant signal for assessing current momentum, and it is negative. Book value growth, a measure of shareholder equity accumulation, over the past 3 years is 10.30%. This is positive and suggests the company is building shareholder equity, though this is partially offset by the revenue contraction we just noted. The dividend yield is 2.79%. Management is returning capital to shareholders through a sustainable dividend, which is typical for cash-generative energy companies. However, the negative 3-year revenue trajectory is a red flag. It suggests the company may be struggling to grow production or replace reserves, which could constrain future dividend growth. In our view, growth is the single largest constraint on ConocoPhillips' investment case. The company is not declining, but it is not demonstrating meaningful expansion either. This is a mature, cyclical business working to maintain production and return cash to shareholders rather than grow the asset base aggressively. Now let's talk smart money. What institutional capital is actually doing with this name? ConocoPhillips has 23 top-tier gurus, or super investor quality managers, currently holding the stock. That is meaningful institutional credibility. Looking at specific holdings, Bill Nigrin at Oakmark Funds holds ConocoPhillips at 2.85% of his portfolio and has been adding to the position, with purchases up 27.24%. Christopher Davis at Davis Advisors, a value-focused manager with a strong long-term track record, also holds the stock at 0.76% of his portfolio and has been adding, with purchases up 12.42%. Yacktman Asset Management holds ConocoPhillips at 2.03% of its portfolio, but has been reducing the position slightly, down 2.38%. These are not household names to retail investors, but they are serious, disciplined value investors. The fact that some are buying while others are trimming suggests divided opinion about the setup. Turning to institutional 13F filing data, which tracks investment manager positions, 11.8% of institutional filers are currently net buyers, meaning more are increasing positions than decreasing them. That threshold of 11.8% is below 50%, which would signal broad bullish conviction. So the smart money is mixed. Insider ownership is very low at 0.33%, meaning management and company insiders own virtually none of the stock. That is a yellow flag. When founders or senior executives own minimal stakes, it sometimes signals a lack of alignment with shareholders or confidence in future appreciation. Over the past 3 months, there have been 0 insider buy transactions but 11 insider sell transactions. This is another cautionary signal. Insiders are selling, not buying, which is the opposite of the signal we want to see. Taken together, while established value investors like Nigrin and Davis are willing to hold and even add to positions, the broader smart money picture is lukewarm, insider activity is negative, and management skin in the game is minimal. And finally, the verdict. Let's bring it all together. On valuation, the stock is fairly priced relative to current earnings and near-term estimates, trading near intrinsic value with no margin of safety. Wall Street sees upside, but that thesis depends on commodity price and cost assumptions holding. On financial strength, the balance sheet is adequate but not fortress-like, with modest liquidity and leverage ratios that leave little room for deterioration. On profitability, the business generates real cash flow and solid margins, with 13.55% net margin and 12.29% free cash flow margin. But profitability is cyclical and highly leveraged to commodity prices. On growth, this is the binding constraint. Negative 3-year revenue growth signals a stalled business, and there is no evidence of meaningful production or reserve replacement expansion. The company is a cash return vehicle, not a growth engine. On smart money, established value investors hold positions and some are nibbling, but insider selling and mixed 13F direction suggest the setup is not commanding strong conviction. ConocoPhillips is a competent, cash-generative energy producer trading at a fair valuation, but it offers limited upside and faces cyclical headwinds. The investment case rests on commodity prices cooperating and management deploying capital wisely, 2 variables outside management's control. In our view, this warrants a hold rating rather than a strong accumulate. The stock is neither a bargain nor a trap, but a mature, fairly valued exposure to oil and gas with limited catalysts for re-rating. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on ConocoPhillips. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.